This is the future of finance.
This episode is brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore, Maryland. Hi, everyone, and welcome to the Future of Finance podcast. I'm George Dyer, and I'm really excited about this episode. We have Brian Minns as our guest, who leads responsible investing for the University Pension Plan of Ontario, or UPP. UPP is a joint defined benefit pension plan for several universities and other organizations in Ontario, Canada. And as we discuss, they've had a really strong commitment to sustainable and responsible investing baked into their approach from the start, which was not that long ago, just 4 years ago. So it was really exciting to hear from a pretty large asset owner, over $12 billion in assets under management so far, that's taking a really holistic approach to this. And we talk about how they take a system level focus to their responsible investing and what that means. We talk about their climate action plan, which includes a commitment to net zero by 2040 for their portfolio. We talk about how they work with external managers on these topics, how they engage with companies. And I think maybe most interestingly, how they think about the dual aspect of both how sustainability risks and opportunities affect their investments on the one hand, and how their investments can help drive the shift to a sustainable economy on the other, and how all of that aligns with their fiduciary duties and their main purpose of providing stable retirements for their beneficiaries. So I really hope you enjoy this one. Please reach out via LinkedIn or leave comments on our YouTube page and let me know what you think. And now here's Brian. Hey, Brian, how you doing? Welcome to the podcast.
Great. Thanks for having me. Glad to be here today.
Absolutely. I'm so excited for this conversation. The University Pension Plan has been such a leader in responsible investing. And I just think the role of asset owners and the work you're doing is so important to all of this. So I really appreciate you taking the time. And we'll jump into all the good work that UPP is doing. But first, let's just tell the audience a little bit about yourself. You've got quite a career in sustainable and responsible investing before joining UPP with Addenda Capital and CPP Investments and Mercer. So I'd love to hear just kind of what got you interested in this space and how you broke into this sector.
Sure. So thanks. So yeah, I got into this space. It embarrasses me to say it, but like almost 20 years ago, or about 20 years ago now, I was in school thinking I was going to be sort of a corporate social responsibility type person working for a big company, doing the foundation thing and the recycling thing. And then someone came in and was talking about how they were evaluating publicly traded companies on their performance on environmental issues and social issues and corporate governance from the view of those things can actually impact investment returns. And I thought, this is it. This is amazing. I can work on more than one company at a time. I can work at lots of companies. And so that company was called Innovest Strategic Value Advisors. And I was evaluating companies in the hotels, restaurants, and leisure space. I thought it was fascinating. I was very fortunate then to catch on with Mercer and investment consulting, working with Jane Ambachur. She was leading a global team there. They had done work with the Principles for Responsible Investment, getting it off the ground in 2006. So I came in very early days there, working with clients, trying to wrap their heads around what they were doing. Did work with the university client at that time, which was great. Mm-hmm. Then I thought, I'm making all this advice, giving advice and helping asset owners and, stewards of capital make decisions, but I don't get to make the decisions. So I thought I want to try it on the other side. So I went to CPP Investments for a contract, and that was great. And then I landed at Addenda Capital, institutional investment manager owned by the Cooperators, so a cooperative insurance company. And that was fantastic because still for profit, but really focused on what's important for their members and their owners. And then, when UPP was advertised, and was getting put into place, I thought it was a tremendous opportunity to take everything I had learned and bring it back to that asset owner perspective.
Yeah. You've really seen it from all the different angles of managers, consultants, asset owners. Nice. So how long have you been at UPP now?
So I've been at UPP for just a little over 4 years. Just 2 seconds on UPP. It's a jointly sponsored defined benefit pension plan for the university sector. So we have about 41,000 members here up in Canada, across 4 universities, so University of Toronto, Queen's, Guelph, Trent, and then next year Laurier is joining as well. Mm-hmm. And then we have hopefully some more universities will join us in the future, and we'll be able to spread the risk of being in a defined benefit pension plan across more people. And then also they'll all be able to benefit from the work we're doing around sustainable investing, but also around strategic asset allocation, and just making sure that we're taking care of the risk and paying people's pensions when they retire.
Yeah, nice. And so how long ago did UPP come together? When was that formed?
Also 4 years ago. So
Okay, so you've been
it
there
was about
from the
a
start.
decade in the making, but it took a while. Started with kind of 30 plus universities, and then it was down to 6, and then it was down to 3 who could really come to terms and figure out how to get this thing off the ground. So we're at critical size, but yeah.
Yeah, that's great. And then there's other types of organizations that participate too, right? Some sector institutions, I think you call them.
There's a few. So some of the faculty associations of some other universities join, and some other groups in and around the space. We think, we do have a fundamental view that a defined benefit pension is an important piece of people's retirement planning, and we hope, as many people as possible can have access to that.
Yeah, the trend has been kind of away from that, right? So this is a deliberate move back in that direction to have that kind of secure pension for the employees. Yeah, nice. Awesome. And so let's dive into the responsible investing aspects of it. I know it's a core focus. Was that kind of from the start, or how did that develop?
Yeah, it definitely was from the start. So everything we do around responsible investing is through the lens of how do we take care of our investments and have the best possible opportunity to pay pensions in the future. So it is very much through a fiduciary lens of what's in the best interests of the plan members. But yeah, through that joint sponsorship model, we have both the employee side. So we have faculty associations and unions, for example. And on the employer side, we have administrators at universities. And they're both independently doing things around climate, around social issues, labor issues, and so on. And it is important to them, and they see the value of paying attention to these issues, and that when they are making investments and when they're earning returns for members or other beneficiaries, that they're taking care of these issues on their behalf.
Yeah. And who kind of drove it as this was coming together? Was it the trustees or the investment team or the employees themselves, or just some kind of combination? There's a lot of stakeholders involved, as you alluded to.
There's a lot of stakeholders, and there's benefits for everybody, I think. So as an employee, for example, there's a benefit in being in a pension plan that's not just tied to one university and what that university is doing, but being tied to multiple employers. So distributing that risk among more people is a very important piece of this. So more and more individuals we can get into the plan, the more that risk is spread out, and the more the fixed costs of running a pension plan are distributed out. And so the cost of doing business goes down across the board. Similarly, from a responsible investing perspective on the employee side, whenever it's a single employer-sponsored plan, that single employer has a lot of sway and a lot of decision-making rights around what that plan does. Whereas in this jointly sponsored model, we share the risk, but also we share decision-making. So the board of trustees, for example, is half appointed by the employer side and half appointed by the employee side.
Oh, interesting.
So you start to see these things that are important come through with how we deliver pension service, but also how we do our investments.
Yeah. And it sounds like there's quite a bit of consensus around the responsible investing focus, just given how much of a focus it is. Is that fair to say, or is there a lot of ongoing debate around that? Or
there is definitely a consensus that these issues can impact investment returns and that we need to identify them and manage them. So absolutely, there's a whole lot of consensus.
That's great. That's great. And then just at a high level, I know there's a lot to it, but what are some of the kind of main attributes of the approach to responsible investing? How do you think about it?
So I would say we kind of have two main streams happening when it comes to responsible investing. On the one side, we have due diligence and monitoring of our investment portfolio. And on the second side, we have stewardship. So on due diligence and monitoring, that means we have a responsible investing team that works hand in hand with our investment department. Whenever we're looking at a new investment fund investment, or we've started to do co-investments in the private markets now. So where we have an investment partner and they identify a specific asset and we think it's particularly of interest. So our team works hand in hand alongside the investment team, but also, tax, legal, and so on, where we're doing an assessment of that investment trying to surface as much of this, financially material, important information around environmental issues, social issues, governance issues, and making sure that we understand them and that they're factored into our investment decision making. Mm-hmm. That's the due diligence. And then the monitoring is we have this portfolio now. And so we're in a constant dialogue with the investment partners in our portfolio over a rolling time period where the vast majority of our investment partners now have somewhere between 2 to 4 responsible investing milestones where we've communicated to them. We see an opportunity for an improvement that we think will make you a better investor or will give us more confidence in what you're doing around sustainable or responsible investing. Mm-hmm. We want to see improvements over time. So we keep track of this just as we keep track of other things we're looking for and look for that continuous improvement.
Yeah. And those investment partners, just to kind of be clear for the audiences, are external investment managers that you allocate portions of the portfolio to?
Yeah. The vast majority of the fund is invested through external investment managers.
Yeah. Nice. And is those private co-investments sort of the one exception to that, where you'll do some direct investing?
It depends on who you ask. It could be quote called direct, but it's always a co-investment. So we've identified a strong partner. Either we're in a fund already, or we're thinking about a fund, or we have past experience with that group, and we'll do a co-investment alongside them. But we're very much a partnership model where we rely on that very strong partner.
Yeah, great. I want to come back to that in a little bit. But one of the other things I wanted to pick up on is the system level focus. And I just want to read this quote from the website because I thought it was great. As a long-term investor, UPP has a responsibility to promote the health of the capital markets and the financial, social, and environmental systems on which capital markets rely. We see the system level focus as essential in meeting our fiduciary duty, which I think is just so important and kind of cutting edge. A lot of our conversations in the Intentional Endowments Network are circling around this point. So just maybe talk a little bit about how you all came to that viewpoint and that focus.
I think it's just serendipity, really. So our CEO, Barbara Zvon, I think has always kind of thought this way. I think I've always kind of thought this way, but the timing was just right. So in 2021, as this was all coming together, UPP was getting launched. So John Lekumnik and Jim Hawley's book around moving beyond modern portfolio theory was published. So it was their articulation of, I think, what we had always been thinking. It's like, hey, you know what? And what we were taught in school even is in modern portfolio theory, but the markets, as strategic asset allocation matters, and how the markets move really matters to how we deliver pension benefits. Mm-hmm. And so maybe we shouldn't just take for granted that we invest in the markets and that we have to receive whatever return it gives to us. Like maybe there's a role for us to play in terms of being proactive and trying to help the markets deliver us sustainable returns over time. Like outperforming a market that's down 20% doesn't help us pay pension benefits that much, versus if the market only went down 10, for example, that would be a huge benefit to us.
Right.
So that kind of thinking was permeating through sort of the leadership group. Our CIO, Aaron Bennett, also thinking this way about how it's not completely abstract finance. This is real world investing that's happening, and that these systems really matter. So that was happening. And then we were very fortunate to bring John and then Bill Burkhart in from TIP. They actually helped us put together our initial investment beliefs, which I think that's what you quoted from, or something variation of that. And that belief actually came from our trustees as well. So we interviewed all the trustees, all of management at the time, and everyone kind of coalesced around these things. And then we weren't satisfied with this idea of there's a bunch of finance stuff and then we should say ESG is important. It was like, no, I think there's really something at the root here around the systems and the importance of systems to everything we're trying to do.
Yeah, that's fantastic. And I think, the work of John Lekumnik and Bill Burkhart and others around this is fantastic. I was actually in touch with them about having them come on and dive more deeply into this on the podcast. But having an asset owner like UPP put it into practice, I think is so critical and important too. And I want to sort of dive now into the climate action plan because I think it's sort of a manifestation of that. And one of the things I love is, you've got this net zero portfolio commitment by 2040 or sooner. And one of the things I love about how it's framed, and I think this just kind of gets to what can be a big source of confusion in this space. And that you say the materiality of climate change for UPP is twofold. On the one hand, UPP's investment returns depend on a stable climate. And on the other hand, UPP's investments can affect the stability of the climate. So it's sort of, this question, are you doing it just for the investment returns of the portfolio, or are you doing it to help stave off the terrible impacts of climate change or help, mitigate them in some ways? And it sounds like you have just a very simple, clear articulation that it's both.
Yeah, it's both. I mean, I think what we see, the research is out there, and I think as we see new research come to light, so as people think about climate scenarios, or they think about not just scenarios, but trying to predict kind of what the impacts will be, like I'm biased, obviously, but my general observations are that each time there's a better and more detailed approach, the worse it turns out things are. It's like the more we know and the worse it seems to be. So tipping points and things like kind of discounted tipping points. We don't have a way of incorporating them into our models, so don't really worry about tipping points. And now tipping points start to come in. You're like, oh yeah, if these things happen, there's going to be like really serious consequences for large parts of the world, and that could really change a lot of different things. The movement of people and energy and food, like really big things. Knowing that, we have to, on the sort of micro level, it's like we need to take care of these climate related risks and be like, if we look at this asset or this company, what risk is it exposed to? Sure, we can look at transition risk, we can look at physical risk, we can look at litigation, and that's very helpful. But the systems view and what the research is showing us is that's not enough, because if we can pick a great company, but if the world's kind of doing this, then the outcomes of that particular company aren't going to be as great as they could be. And so that real world focus is always front of mind for us, is like, make good investment decisions. So that's one part of our climate action plan, is about understanding, evaluate, know where we're at, know what the risks are, make good decisions, incorporate it into those top of the house decisions around strategic asset allocation, for example. But also know that system needs to be better as well.
Yeah. And how do the conversations look when you're talking to managers about that? A lot of the external managers you work with sort of get that pretty intuitively or focused on it, or is it a bit of an education?
Some of them do, and some of them not so much. But I think it goes back to that sort of micro macro piece. It's like you almost don't need to understand the systems view if we can articulate it in sort of what our expectations are and what we're looking for. And I think it goes to that systems approach and some of the work that Bill and Tip and Monique at Tip do as well. Like you have to go at these things in multiple levels. It's not one approach to fix one problem. It's like we've got to kind of throw lots of stuff at this at multiple levels. So articulating to our partners that this is important to us. We expect you to be able to do things like calculate Scope 1 and Scope 2 greenhouse gas emissions of the portfolio. Maybe that's not the most material thing for that company, but knowing that you, manager, can do those calculations and have some confidence in it helps us know that you're wrapping your head around this climate issue. And if you have that information, you're on the path towards taking better actions. So, it's not always straightforward, but we find ways in.
Yeah. Well, let's come back to the climate action plan, because I think it sort of gets to that point and talk about some of the pieces. And let's start with that one, the sort of portfolio footprint, carbon footprint of the portfolio. Just tell us a little bit about, the progress you've made in reducing the portfolio emissions, and how you've sort of thought about setting targets for emission reductions at the portfolio level.
Yeah, so UPP, we joined early on. We looked at a couple of different climate-related initiatives. One of them was the Net Zero Asset Owner Alliance. And we wanted our approach to be rooted in science, essentially, like what needs to happen here. And so the Net Zero Asset Owner Alliance has a science-based approach to target setting. And they had already set parameters for what was needed by 2025 and what was needed by 2030. So we said, okay, these are the goalposts that are being proposed by this group. The IIGCC, so the European group that's looking at climate change, also had a framework in mind. But we wanted to say that, like, we need the right sort of goalposts for this. And we want to both address our own portfolio, but we also want to signal that we're aligned with where we think the world needs to go. And so we set a target for 2025 of 16.5% reduction, and we set a target for 2030 of a 60% reduction from our baseline. So baseline being our first calendar year end of 2021.
Mm-hmm.
So we said, okay, what are the right scientifically relevant goalposts? And then we said, okay, how can we get there? and
Right.
like, let's make sure we can. For 2025, we said, okay, these are the levers we can pull to get there. For 2030, we have a number of different pathways that we mapped out and said, oh, well, here's one way we could do it, and here's another way. And wouldn't it be great if we went this way, which involves companies actually peaking emissions and their emissions going down? But the reality is that's not really happening yet. So we went through all that process, got everyone comfortable with we're setting the right scientifically correct target, and also it's something that we can achieve internally. And so we've made progress towards it. We achieved our 2025 target. We are quite a bit on our way towards our 2030 target, but I would say that we won't know that we hit our 2030 target until 2030.
Right.
We could be dancing around it, but we have to sort of have sustained lock in there at a lower level.
Mm-hmm. And how does that look? So to reduce the portfolio emissions, you can do so by choosing what to investing in lower emitting companies, divesting from higher emitting companies, or you can engage with the companies in the portfolio to reduce their emissions, as you said, so they peak and decline. And it sounds like, it's a combination of both that you're taking. And so was the sort of divestment or kind of investing away from those high emitters the first step that got you sort of the quick reductions to the 2025 target?
Yeah, so it's a combination. So yes, we do have some exclusions in our portfolio around thermal coal, and one thing we've been able to do over time is move a number of our public equity mandates from pooled vehicles into segregated mandates where we can actually apply our exclusion. So yes, that has been helpful. The second thing that's been helpful is that we've been trying to deploy more assets into private markets, and so we've been putting money into infrastructure, for example, into real estate, into private debt, and into private equity. So our teams have found some climate opportunities in there with solution opportunities that have also led to our carbon footprint actually being lowered as well. So those two are both happening. And then you mentioned stewardship. Yes, so we put together a climate stewardship plan as well that said, well, let's look at some of the 20 of the largest emitting companies in our Canadian portfolio, make sure that we're in a dialogue with those companies as well. So it's multiple things going on, trying to tackle that problem.
Yeah. Let's talk a little more about the climate solutions, because one of the sort of critiques of the portfolio footprint concept is that might be great for your portfolio, but what is it really doing for real world emissions? And, as you said, you're investing in climate solutions, and sort of how big of a piece of the puzzle is that for your net zero commitment, and what are those opportunities looking like broadly?
I think it's an incredibly important piece of the puzzle. I think, yes, we are not overly focused on our carbon footprint of our portfolio, as you said, because we can make decisions ourselves, which we think are good investment decisions and sort of mitigate some of the climate transition risk that we see, but they're not fixing the big physical problems that we see in the real world. But I think that is where we see opportunities in climate solutions. So a couple of examples. So we've invested with a partner called Copenhagen Infrastructure Partners. So this is a Denmark-based organization that does a lot of greenfield, so new renewable power generation capacity development. So they're doing offshore wind, onshore wind, solar. They've done a bunch of storage. So we invested in one of their funds that's doing this work in developed markets. So they're putting new renewable energy into grids around the world. We've done some co-investments with them now as well, looking at some slightly different things. So a great partner where our capital is going into new things. So they're not buying pre-existing assets. They're actually doing something new. Another example also in infrastructure that I would highlight is a company called Angel Trains. This is a UK company that leases railroad cars to the railway operators. And so 70 to 75% of the fleet is electric at this point in time. They have a like a full-on transition plan, CapEx, everything ready to go to get it to 100%. So mass transportation, mostly electric, going to be fully electric in the future. So we just see these opportunities, and but it has good characteristics for us as an investor as well. These are very long-term contracts.
Mm-hmm.
And so we see a lot of positive opportunities like that to deploy capital, get good returns for our members, but also see that capital go into some interesting things for the climate.
Yeah, that's very cool. I mean, I think that's where so much of the focus needs to be right now. And I think and hope, and you're in this day to day, but that's where so much the opportunity can and I think will be as we go through this transition. So that's great. And what about if, how do you think about it if some of those investments that are driving climate solutions, but might have, some emissions associated with the company or the projects? Now, do you just sort of, not get too precious about the portfolio carbon footprint if the investment's going to drive that real world transition?
Yeah, so that is exactly it. Is we've made some good progress on the footprint, and I've said to our investment teams like that the footprint can never be the thing that stops us from making an investment that will have real world impact on climate emission or carbon emissions. And so that's a very live conversation. And we don't have some other investors have a transition sleeve, so very clearly defined place to put investments like that have a sort of a science-based target towards net zero. But we have a similar mindset in terms of wanting to be able to do those investments and be comfortable that our emissions might go up sort of year to year as we do some investments like that. But we want to be able to demonstrate that those investments would actually see tangible, real emission reductions over time.
Yeah, nice. This episode is made possible by Metis Global Partners. A global equity solutions provider managing over $5 billion, Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. The Intentional Endowments Network's 2025 annual forum will take place on October 27th and 28th at Goucher College in Baltimore. This forum will convene 100 to 150 endowment, foundation, and sustainable investing industry leaders to discuss how to maintain intentional investing momentum at your institution, covering topics including system-level investing, the fiduciary duty case for sustainable investing, strong democracies and political risk, climate risk and opportunity, responsible technology and artificial intelligence, inequality as an investment risk, and taking an expansive approach to talent. The program will be designed for endowment and foundation trustees, chief investment officers, and investment teams, as well as practitioners from investment consulting, outsourced CIO, and asset management firms. IEN events are intentionally designed to be highly interactive with plenty of time dedicated to dialogue at roundtables and networking, in addition to excellent presentations from experts and peer institutions. Go to intentionalendowments.org and click on Annual Forum to learn more. A big piece of this transition globally is the Paris Agreement and some of governments around the world thinking about how to decarbonize. And a lot of investors have looked at like Paris-aligned strategies. And I think there's a tension there between where we're trying to go with the Paris Agreement versus where we will actually go. We're not sure, obviously, how successful we'll be. And, something that caught my eye on your website too is that part of the commitment is based on the expectation that governments will follow through on their own commitments to ensure the objectives of the Paris Agreement are met. And I'm just curious, given where we are, Trump administration pulling the U.S. out of Paris again, do you have concerns that governments will actually follow through? And sort of what's your contingency planning, I guess, that if we don't meet those expectations?
So I'm quite worried, to be honest.
Yeah, I think we all are.
Paris, we're like at 10 years. So
yeah,
emissions are still very, very, very high. We've used up a lot of the budget that would keep us at 1.5 or 2. So it's very worrying. And the reality is that we despite our efforts around systems level investing and try to encourage change in the system, we also are investing in what's available to us as an investor. And so I think when we originally think about Paris and go back then and you think about what would the world be like 2040 or 2050, you would be thinking about a portfolio of companies and say in the public markets where the companies themselves would be net zero. And so as you add those to your portfolio, it doesn't have any impact on the net zero nature of your own portfolio, or even some companies we're talking about being net negative. So, that was the kind of portfolio and the opportunity set that when we put these plans in place, we're expecting to see starting to appear. If we don't see that starting to appear, it's going to be hard for us as an investor to hit net zero by 2040. We are primarily in the business of paying pensions. And so that will always be the number one thing that we have to do. We face these transition risks, we face the physical risks. But if these emissions don't go down, the physical risks are just going to keep rising.
Yeah. So you can have that orientation still, but you're always kind of constantly reevaluating what the political reality is and where the real economy is going. Is that fair? Yeah. Well, on that point, policy engagement is another kind of pillar of a lot of net zero commitments. And so what does that look like for UPP in terms of engaging with, public policy?
Yeah, we think it's incredibly important and often sort of an underutilized tool in the tool set that investors have available to them. Yeah, we can go and have conversations with companies, and we do, and we talk about maybe they should set targets to reduce greenhouse gas emissions, and maybe they can, increase the resilience of their operations. And they will do those things when they view them to be in their best interests and long-term interests. But there's a limit to how much of that voluntary action and self-serving, frankly, sort of win-win action will get us. It's not going to get us. It will get us through incremental changes and incremental improvements, but we're talking about a whole of system change for energy, for example. People aren't going to do that voluntarily and willingly. And so public policy has to play a role in that. And we as investors, if we see that physical risk is so dire and so extreme on our investment portfolio, we have to play a role as appropriate to try to influence public policy to try to address that physical risk that we see. And so we have intervened or gotten involved in things around a cap on greenhouse gas emissions in Canada's oil and gas sector. But also as an investor, we need data to make good decisions. So we've been following very closely the work that's been done by the International Sustainability Standards Board and how that's, being or is in the process of being adopted in maybe up to 30 jurisdictions around the world, and how that will help our investment managers make better investment decisions about climate risk. So we've been pretty active in terms of whenever there's a consultation in different parts of the world, they're thinking about adopting these disclosure practices. We've been sending letters to the regulators in those places. And then in Canada, we've been very active working with other investors and the regulator trying to encourage adoption of these international standards.
Nice. What does that look like? So letters is one piece. Do you have like a government affairs person or department? I mean, do you go talk to policymakers? And
to have a government relations person, and they have a number of things on their sort of priority list, and sustainable finance related issues is one of them. And we get support from them, on topics where we've identified as being quite important. Yeah. And I think that's what we need to do. We need to be professional about this. And we know our role. We are a long-term investor with 41,000 members, but we're trying to achieve things that we think are in their best interest over time.
Yeah. Well, let's talk about that too, because you mentioned that sort of core is making sure you can deliver for the beneficiaries. And you talked about the fiduciary duty focus, which is central to what you do, obviously. And I guess just talk about how you think about that in light of this responsible investing strategy, the net zero commitment, both in terms of like how the financial performance needs to be there for retirees, but also the whole concept of them retiring into a world that is stable and has a thriving economy and not breaking down in climate chaos.
The lawyer in me would say that that retirement piece, I think I am good with that. But the lawyer in me says, no, it really is just about financial returns for the most part. Now,
Hmm.
but it is about buying power and what can you do with that money and how do you have to spend that money as well, I think. So our focus as an investor is on what's in the best interest of the plan members financially. But often those things it's hard to distinguish any difference between what might be in the best interest of the plan financially and what might be best for someone's retirement outside of financial interests, I think. So there's a lot of overlap.
Yeah, and I think it comes back to that whole concept of just that breakdown between sort of the theoretical economics of it all and the real world that we're dealing with. And these impacts, like you say, will, in terms of purchasing power, will also drive up prices, in terms of like climate inflation impacts and the like. So, but yeah, it's tricky. I mean, I think it is an uncomfortable place for investors in some ways because of that, just like traditional focus purely on traditional financial outcomes without thinking about some of these new systemic impacts that are really global and all encompassing. Yeah. So what do you think? I want to talk a little bit about like barriers and opportunities. And yeah, just talk a bit about what have been maybe some of the main barriers and what you see as the big opportunities coming forward, and maybe particularly in light of some of the anti-ESG backlash or impacts, particularly in the US, if that's affected your approach at all.
Yeah. So I think barriers wise, that fiduciary duty question is like something that I've been dealing with for 20 odd years since I started into this space. I think it's unfairly sort of maligned around that fiduciary duty, and also the barriers around language I think are a real problem. So the idea, like this idea of like, oh, are you investing in an ESG fund? It's like, well, what is an ESG fund? I don't even understand what that means.
Right.
Like, is it about practices? Is it about what's in the portfolio? Is it about what outcomes you're seeking that aren't financial, or is it about financial? Like there's so much sort of mixed up in all of this, and you see
Mm-hmm.
like BlackRock, for example. It's like, oh, Texas has put BlackRock back on the eligible to use list, and then today or yesterday we see like PFZW or PGGM, these big Dutch fund, has just fired BlackRock from a bunch of mandates because they're not doing enough. And it's like, well, okay, like I don't like
Right. Which
what
is,
who's doing what here. Like,
yeah.
so language is a real challenge, and that's something we still face when we meet with potential investment partners, for example. Sometimes the initial conversations are about, again, like recycling and maybe business travel, and maybe they talk about exclusions. And it's like, no, we're talking about, do you think about things that could impact the investment performance that are environmental nature, maybe it's or social or geopolitics, for example. And then you can, once you start to get under the hood a bit, you start to have a conversation. You're like, yeah, what you just said is an example of an E issue, but for whatever reason, you don't think of it that way. Like, so I think language is a big one.
Mm-hmm.
I think the pushback, like what's happening now, maybe is the barrier. It turns out was that people were trying maybe perhaps to say they were doing more than they actually were.
Mm-hmm.
Uh, so that was a barrier. Maybe now that barrier is coming down a little bit and people are being a little more transparent, clear about what they are doing. So maybe that's a positive that's coming from this.
Mm-hmm.
Um, I'm not sure.
Yeah.
An opportunity. Oh, go ahead.
I was just going to say on that piece, is it clear for you when working with managers which ones are really committed in this context and which ones have backed away?
I mean, that's the big question is, are we really getting to the heart of what, we talk a bit about philosophical alignment. It's like, do you agree with us that these things are important? Maybe you're
Mm-hmm.
not doing all the things we would do, but if you as a manager are doing some of the things and you can articulate why you're doing them, then we're like, yeah, I think we're philosophically aligned here. And I
Mm-hmm.
think that's what we strive to understand. But there's, you know, they, there's a lot of money at play. So people want to tell you the things that they think you want to hear. So
Right.
you do really need to try to get as far underneath as you can and talk to the right people, talk to the people who make decisions. Yeah.
Mm-hmm. Yeah. Nice. And sorry, I cut you off there. Talk a little bit about some of the opportunities you see.
Well, I was going to say, just on the opportunity side, I think despite the headlines, I think renewable energy is a big opportunity. Like
Mm-hmm.
we are going to need an awful lot of electricity in the coming years. Even if you got rid of AI from that equation, you're going to need a lot of electricity. So I think, and it's a lot of it's going to be renewable. It just makes economic sense at this point in time. So
Hmm.
I think that those sorts of realities are electric vehicle, like some of these things, there's really still some positive notes and positive light that comes to the front. You're like, yeah, okay, I guess we are making some progress here. Things are good.
Yeah, well, the cost of solar and storage, just continues to come down. That's been a story for a long time. But the think tank Ember out of the UK put out a paper this summer that showed, I think, a 22% drop in storage or battery costs. And yeah, the fundamentals are just changing so quickly that, yeah,
I think
put a lot of hope in
I
market.
saw a headline. I probably shouldn't quote it. I won't quote any numbers, but it was about Pakistan, how they had devastating
Yeah.
flooding, but there was a catalyst around like a rethink on distributed energy, and I think diesel demand is down. I won't say the number, but it's more than single digits, let's say,
Hmm.
because there's solar plus storage out there as an alternative to generation from diesel.
Yeah, that's a fascinating story in Pakistan, just how much of the grid has shifted to solar so quickly. And yeah, I think that can happen faster than people think a lot of the time. So
So
yeah, I think there's some hope there. Well, nice. And another piece of the strategy I know is working with other investors. And just curious if you could talk a little bit about how you think about collaborating. I know you're involved in leadership roles in a lot of associations or groups of investors there in Canada. Talk about how that plays into your thinking and strategy.
I think I've had a soft spot for collaboration. I think there's just always a tremendous opportunity around it as well. And I think I've heard people call it sort of pre-commercial collaboration. So it would be, a group of people who have, jobs similar to mine in investment managers or pension funds, you know, if there weren't that many at the time, like just getting together to talk and share the challenges that they're facing, the opportunities that they see, and like th- what can really come from that positives around shared terminology or shared nomenclature or like, yeah, we should really write a report about impact investing. Like these things, they just like these people exist, and if they don't talk to each other, they might go off and do their own thing and kind of do, you know, a one and a one and a one. But if you put everybody together, it's like, oh, we did a five together because we're now kind of all on the same page and we're
Hmm.
getting it out there. So I think there's a ton of value from that, both the structured sort of narrative, you're trying to achieve something, but also I've always had a lot of value in the informal collaboration as well, like having coffees or after work drinks and so on, like just where people are sharing their stories and looking for ways to work together and make things better.
Yeah, and I mean, I think especially in this space, there's such a shared purpose around a lot of it. When you're in those groups, do you find that you and UPP are kind of at the cutting edge of a lot of this, or is this a lot of groups in Canada sort of this far
I
along?
think, yeah. So like in Canada, we're so for example, Canadian Coalition for Good Governance, that is a pretty well-established organization focused on corporate governance,
Hmm.
but they do have an environmental and social committee, and they also have a public policy committee. So and our chief investment officer just joined the board as well. And so these spaces are open to these things. And yeah, maybe we push a little bit and we might say some things that maybe the sort of more conservative, longer term members, don't always love, but I think it's important to get in there and sort of say, hey, wait, let's let's talk about these issues at least. Maybe it's not the right thing for this organization to do, but maybe a sliver of it finds its way into the work plan. And I think we do when we speak up too, we find some very receptive conversations. I could think of one where we were talking about executive compensation, and we have an inequality stewardship plan, and part of it is around voting against executive compensation when the CEO is paid quite a bit more than the median income within a given country, US or Canada.
Hmm.
And that's not a very common approach. People don't like to put a little cap on that. But we tabled it for discussion, and it turned out there were a couple other investors that were like, yeah, I think things, and we talk about where we set it and how many companies that meant. So for Canada, it's like less than 20. They're like, oh, that seems like a practical approach that, maybe is reasonable to think about. So it's important to be at those tables and then to not self-censor too much and just say, yeah, these are the things we're thinking about. Anybody else?
Yeah, it's such a great point. I mean, I think so much of this makes sense, and so many people just, by no fault of their own, so you're kind of stuck in the way we've always done things or what the norms seem to be. And sometimes raising these issues can really lead to good conversations to change things in ways that just make sense.
The last one I'd add is UNI, so the University Network for Investor Engagement. So this is one kind of addresses a resource issue in the university sector where, as I said earlier on, like the universities, the administrators, staff, and so on want to do things around climate change, for example. But if they're not in UPP, then the resources devoted to management of investments may not be as great. So UNI is an opportunity for multiple universities who are concerned about climate change and want to see some action within their portfolios. So it's an organization called SHARE, the Shareholder Association for Research and Education, does direct engagement on behalf of that group with companies in Canada around climate issues, things like setting greenhouse gas emission reduction targets, putting together transition plans, disclosing risks and opportunities. So it's a way for people to give life to a thing that they would like to do, but just don't have the capacity necessarily to do by themselves.
Yeah, it's a great model. And we've talked to Cher about it and how we might, sort of amplify it more here in the US, because that's a big challenge, I think, for everybody. It's just the time, staff, resources, even for institutions that have relatively large endowments, it might seem like they've got all the resources in the world, but oftentimes they've got small teams managing it, and they're careful around that. So yeah, that is a good one for people to check out. Nice. Well, kind of back to your point about putting things on the table for consideration. Would love to hear if there's just one or two things that you wish more asset owners would be doing, if you could kind of put a call to action out to trustees or investment teams in these areas.
I think, having spent about a decade with an investment manager, I would say my call to action would be around the investment managers and that relationship. Asset owners are the stewards of capital. Asset holders is something I've heard people starting to call it these days. And I'm like, yeah, I guess we are not really the owner, we're the holder. But these investment managers, we pay them a lot in fees. And often we fall, like I'm on an investment committee for a charitable foundation, and you kind of fall into a rut, which kind of have to shake up a little bit, where they'll come and tell you about how they did over the last quarter or the last half of the year and what their outlook is for the next little while and so on. And it's like, well, you can control that agenda a bit more. You can say, I want to know 2 examples from you at the next meeting of how you talk to companies in our portfolio about what they're doing about climate change. And then, so the first time you can say, hey, you figure out what those 2 examples are. And then you say, a year from now, I'm going to ask you about 2 companies in the portfolio and what you've done about climate change. I'm not going to tell you what those are in advance. So you better come prepared to talk to climate risk in the portfolio and sort of start to have those dialogues on those issues that are important, right? They get paid a lot of money. And they kind of fall into their set way of doing things, and it's okay to kind of shake that up a little bit and provide ample notice that you're going to do that. But there's an opportunity there.
It's a great point. I mean, just raising these issues drives, I think, so much thinking and can drive conversations and change. And it doesn't cost anything. And like you say, you don't have to be unreasonable about it, but you can really make a lot happen there. Yeah. Nice. All right. Well, just to wrap up, Brian, I got a few kind of quick takes we'll run through quickly, and then a couple final questions. But firstly, what's your favorite thing to do outside of work when you're not thinking about these issues?
I would say right now it's music related. So I have 2 daughters. They're 16 and 14 now. They're getting into different sorts of music, and we've been to a few concerts this summer. And I think it's been fantastic to take them to go and see music. One of them's from my childhood, the Wu-Tang Clan. It was amazing. So
that's awesome.
A lot of fun.
That's great. I have a 13-year-old, and last concert I went to was Taylor Swift, which was a little different than Wu-Tang, but also great, amazing.
Oh, very good.
Yeah. How about who's been kind of the most influential person in your career on your path here?
Yeah, I think it's been a great career path for me. I think a lot of it started with Jane Ambixer, who was at Mercer. She challenged me a fair bit, and one of the things she did was said, hey, you can go and get chartered financial analyst designation while you're here at Mercer, like you should just go ahead and do that. Or maybe you should take on some sort of everyday, investment consulting work, even though it's not related to sustainability, just so you learn.
Mm-hmm.
And I thought that was very helpful to me. But I've had other pretty influential women as well. So Barb, who's my current CEO, was fantastic. And then Kathy Bardswick is CEO of the Cooperators Group for a long time.
Mm-hmm.
And she was a fantastic, just sort of the kind of leader that is just amazing.
Yeah, nice. I love to hear that the women leaders leading to good things. How about what's making you most optimistic right now in the sustainable investing world?
I think it's in people like you, George. It's meeting people who are, despite everything that's going on in the world, they're still upbeat and positive and striving and working hard and committed to what they're trying to achieve. And they might be a little bit discouraged, and some of the conversations might go a little bit dark, but they're still like working towards, they've got their beneficiaries in mind, and they think, I got to do these things to try to get the best outcomes. Or if it's a foundation, they're like, we have to do these things in order to have the best outcome. So I think people is the most positive thing right now.
Yeah, that's a great point. It's all we can do, right? How about a resource, a book, podcast, or article that you'd recommend to our listeners?
I would go back to Moving Beyond Modern Portfolio Theory again. So
Mm-hmm.
John LeComnick, Jim Hawley. It's a little read. I think I do have a copy right here. It's a little one, but it's just kind of opens the mind a little bit and gets you thinking about the importance of systems and the work that we can do there.
Yeah, fantastic. I love it. All right, and our two final questions we ask everybody. Well, given your work and perspective, what is your vision for the future of finance?
The future of finance.
What's it going to look like?
I think the future of finance needs to go back to basics. It needs to go back to allocating capital to the highest and best uses for society. I think it can happen. It's going to be a long road to get there, but I think the financialization of the world, it helps us as a pension fund in some ways, but for the most part, I think if we can go back to what's the point of having a corporation and what's the point of finance, I think we would be definitely going in the right direction.
Yeah, that's a great point. I think people sort of tend to think of all this just about profit maximization, like that's the way it's always been, but it all started with the purpose of, how do we make lives better? How do we get things done more efficiently? Yeah, nice. And how about advice you might give for college students or young people interested in the space?
I think I would pick back up on the leg up that I think Jane Ambisher gave me. So CFA, Chartered Financial Analyst, like people, I meet, do little coffee chats and things from time to time. And I would say, hey, even today, there aren't that many sustainability focused jobs, but if you can get a job at a real estate firm or at a bank and become an expert, or at least gain some direct knowledge of how that business works and what's important, as you're there, you can find your way to sort of wiggle in your sustainability things and join what's happening out in the industry. But if you have some expertise, you're going to be useful to people. And then you can pile on the sustainability all you want.
Yeah, and be more effective in doing so, for sure. Nice. Awesome. Well, Brian, thank you again so much for the time. It's always a pleasure, and I hope to talk to you again soon.
Yeah, thanks so much for having me.
Take care. This episode has been brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.